Hey everyone, welcome back to Financial Futures. In today's video, we're diving deep into an important topic, the housing market update you've all been waiting for. The Federal Reserve started cutting interest rates last week, and it's a game changer. They've made it clear that they'll continue cutting rates throughout this year, next year, and even into 2026. So, let's talk about what this means for mortgage interest rates, home prices, and you. First, let's look at where things stand right now. The median sale price of a home in the U.S. has skyrocketed 46% over the last 5 years. Year over year, home prices are up 3.1%. But if you take a close look month over month from July to August, you'll notice something interesting: home prices have fallen slightly. Now, is this a sign of a housing market crash? Let's dig in. I know many people are quick to jump to conclusions whenever they see a drop in prices, but I want to be clear: the housing market has not crashed. Sure, some people might keep saying, the crash is coming, but they've been saying that since 2021. Here we are, almost at the end of 2024, and we're still standing strong. Now, there are a few out there saying prices have already crashed, but seriously, if that were true, why haven't your property taxes or home insurance premiums dropped? Exactly because they haven't. Now that we've cleared that up, let's get to the real issue at hand: mortgage interest rates. The Federal Reserve cut the federal funds interest rate from 5.5% to 5.0% last week. That's huge. While it's not a guarantee, mortgage rates tend to follow suit when the Fed cuts rates. And guess what? Mortgage interest rates are already dropping. Reuters even reported that they've fallen to a 2-year low of 6.15%. The Federal Reserve has already projected more rate cuts: another 0.5% cut this year, a full 1% next year, and even more cuts into 2026. So, logically speaking, we can expect mortgage rates to continue trending down. By Q1 2025, I predict that mortgage rates for a 30-year fixed mortgage will settle around 5%. Sure, it's not the 3% we saw a couple of years ago, but it's a big improvement compared to last year's 7.7%. If you're thinking about refinancing, your window of opportunity is coming up very soon. Now, of course, nothing is set in stone. If inflation suddenly starts to accelerate, the Fed might halt these rate cuts and even raise rates again. But honestly, I don't see inflation re-accelerating meaningfully anytime soon. And even if it does, that won't happen for another 9 to 18 months. By then, we'll already have seen the benefit of lower rates. So, what about home prices? If mortgage rates continue to fall, demand for homes will increase, which could add some inflationary pressure to the housing market. But it doesn't automatically mean home prices will skyrocket. It just means that if prices are falling, they won't fall as much. And if they're rising, they might rise a little faster. Now, my personal opinion is that the Federal Reserve is making the situation worse by inflating the everything bubble. They're pumping more money into the system, and lowering rates is only fueling inflation. While I don't think we're heading for a crash anytime soon, I do believe that the longer this continues, the worse the eventual fallout could be. So, the big question: is now a good time to buy a home? Well, let's look at the facts. Back in 2007, before the housing crash, the median home price was around $240,000. Today, it's about $433,000. The best time to buy was years ago, but if you're planning to live in the home for at least 4 years, buying today is probably better than waiting for tomorrow. In summary, the Fed's rate cuts will likely drive mortgage interest rates down, but don't expect them to return to 3% unless there's another major crisis. If you're looking to buy or refinance, now might be the time to act. Let me know what you think in the comments. As always, don't forget to subscribe to Financial Futures and hit that notification bell so you don't miss any future updates. Thanks for watching, and I'll see you in the next video.